I'm Sean Cooper, president and owner of Fit Financial Consulting, LLC, a registered investment advisor. Earlier this week, I talked about term insurance, and I want to conclude the insurance discussion by talking about whole life insurance. To start off with, on Monday when I talked about term insurance, I talked about it being the cheapest form of life insurance. So I want to start off by explaining why whole life insurance can be so much more expensive. To begin with, whole life insurance is designed, like it sounds, to cover your entire lifetime, which means provided you continue paying your premiums, there's no lapse in coverage, you are virtually guaranteed to make a claim on your whole life insurance, or rather your beneficiaries are virtually guaranteed to make that claim. Whereas term insurance, more often than not, expires worthless. Second, whole life insurance can actually build a cash value, which means a portion of your premiums, however small, is not necessarily going towards the insurance itself, but actually going towards this cash value that you can build up over time. Lastly, there are a variety of other features that can be tacked on to whole life insurance that create higher administrative costs and therefore contribute to higher premiums as well. All of this leads to the biggest disadvantage to whole life insurance, which is the higher cost. So if cost is the biggest disadvantage to whole life insurance, let's discuss some of the advantages of whole life insurance. And the biggest advantages are going to be the lifetime coverage, which I mentioned, fixed premiums. If you choose to keep them fixed throughout the time, you may have the option to vary them if you choose. You can grow that cash value like we discussed. You have the potential for flexible premiums depending on the policy that you've elected, and you can potentially withdraw some of the cash value that you've built up over time. I think a lifetime coverage is pretty self-explanatory. Unlike term insurance, it's not designed for a specific time frame, it's designed for your entire life. However, the cash value can be far more complicated. So as I discussed, a portion of your premium actually goes towards this cash value as opposed to just straight insurance, and it can grow over time. So depending on the type of company that you're investing with, it may be a participating company in which you actually participate in ownership of that company by buying that whole life insurance, in which case you will most likely be paid a dividend from that company depending on their profitability, or you may actually be able to invest in the market, so invest into a variety of different funds or something along those lines. As this grows, you can use that cash value for a variety of different things. First off, you can actually use the cash value to cover some of your premiums, or use the dividends to cover some of your premiums. And depending on how large that cash value is, it can either be used for temporarily to cover premiums just because you're in a not in the right place financially to cover it yourself, or if the cash value is actually large enough, it may be sufficient to cover your premiums into perpetuity, which is a very nice advantage. Additionally, you can actually withdraw that cash value yourself in the form of a loan. Because it's a loan, it's going to be tax-free, which can be very advantageous. With that said, keep in mind, when you repay that loan, there's not going to be any type of tax deduction for repaying it because you weren't charged taxes to begin with because it was a loan, unlike a house or something along those lines. Typically speaking, whole life insurance companies do not require repayment of the loan, but keep in mind that is absolutely the intent of the loan, for you to repay it at some point in time. And as long as you have that loan outstanding, you want to be very sure that you continue to pay your premiums to avoid a lapse in coverage. Because if that coverage lapses, it's going to generate some very unfavorable tax consequences as it relates to that loan. Basically, all the tax advantages go away. Those are some of the biggest advantages of whole life insurance. But aside from cost, what are some of the other disadvantages of whole life insurance? First off, I want you to be very skeptical if an insurance agent paints too pretty of a picture of the cash value within your policy. And what I mean by that is multifold. But first off, if you're only going to pay the minimum premium, the minimum requirement, roughly 90% of your premium payments, your monthly payments, is going to go towards covering the insurance, and only about 10% is actually going to go into the cash value. Now, that is a rough estimate, but over the first few years, that's a pretty good idea of how much is going towards just insurance and how much is going towards your cash value. So if you just pay that minimum, you've effectively created a very, very expensive permanent form of term life insurance. And that ratio will improve over time, but it is rather slow. For that reason, and it sounds counterintuitive, but you actually want to fund your whole life insurance policy. So if you're going to buy whole life insurance, you want to fund it with as much money as possible without causing it to MEC. Now, MEC, M-E-C, stands for Modified Endowment Contract. So essentially, if you overfund your whole life insurance policy, the government says, no, you're not using this as insurance, and we're going to take away all the tax benefits. So that's what that means. Putting it another way, you want to purchase the smallest death benefit for the amount of premium that you can afford. And I know, like I said, that sounds very counterintuitive, but the extra money that you're putting into the policy is far more effective at funding the cash value than it would be if you just paid the minimum and effectively lined the pockets of the insurance company. The second area to be skeptical of when you're looking at illustrations or quotes is with regard to the expected return. I've seen a variety of illustrations that show returns in the neighborhood of 8 to 12%. And that's derived from the company paying you that dividend. They're expecting your entire gain to be produced from the profitability of the insurance company, or if you're invested in the market, from whatever your investments are, which I think is probably a little bit more likely, but still we're talking about 8 to 12%, which I would put in the realm of a very aggressive investment. In either case, whether it's dividends from the company or market gains, domestic equities have averaged 8.91% over the last 68 years. So to produce a dividend of 8 to 12%, the company has to not only cover their expenses, but pay you that stated rate. And this suggests a belief that the company can outperform the general market for an extended period of time. In fact, your lifetime, however much longer that may be. I hate to burst anybody's bubble, but for an individual company to outperform the market sufficiently for even 50 years, they would actually have to increase their share of the overall market by 300%. Statistically speaking, I'd say there's probably a better chance of them going bankrupt than of them achieving that feat of growth required to give you 12% over the long term. Additionally, demographics dictate that even if 12% was attainable in the past, it's not likely to be achievable going forward. In a prior video, I actually talked about the funding issues facing Social Security. And Social Security has always relied on an ever-expanding workforce, an ever-increasing population of people paying into the system. And the baby boomers have effectively debunked that whole process. So Social Security's funding issues have been on the horizon for quite some time now, but they really reared their ugly head in 2018 when Social Security took in less than it actually paid out. And it's not the first time that's happened, but it's the first time that it's happened and is projected to continue to happen and even get worse over the next couple of decades in line with the baby boomers retiring. Unfortunately, life expectancies dictate that insurance companies are likely to face the very same problem going forward as their funding of benefits, death benefits, increases while the pool of proceeds, people paying in, decreases. Because the generation below the baby boomers, the generations below the baby boomers, are not only smaller, but a smaller percentage of them have even shown interest in purchasing life insurance in the first place. In fact, if you look at the income statements of many insurance companies today, you'll find that they already show a narrowing margin as premiums received decrease and benefits paid out actually increase, causing reduced profitability for those companies. The point is, basic math dictates that the absolute best return you should assume within your illustration of your whole life insurance cash value is the same as the market, and that's best case scenario. And that's only of the funds that you actually have working for you. Keep in mind, as we discussed earlier, a large percentage of your premium is going towards insurance, covering the insurance, not the cash value where it can actually grow. Which is why many agents may try to sell you on the idea that your cash value will equal your premiums paid in just 7 to 15 short years. And the lower end of that spectrum, the 7 years, is often based on those high return expectations previously discussed. The idea here is not to say that you shouldn't purchase whole life insurance. Far from it. The whole point is that you should proceed with caution. The assumptions and claims made within the illustrations may not be nearly as realistic or feasible as you might like to believe. So when does whole life insurance actually make sense? In previous videos, I talked about the idea that it could work for business partners or key employees. For individuals, though, whole life insurance typically makes the most sense when you've already maxed out your retirement contributions, or in some cases need earlier liquidity than retirement accounts might allow for. And in both of those scenarios, you want to make sure you have a very strong cash flow that would allow you to maximize contributions to effectively take advantage of the cash value and subsequently the tax benefits of the cash value and death benefits of that policy. Even then, it's wise to make sure to compare the whole life insurance policy to other investment options. Before I wrap up, I want to discuss the different types of whole life insurance, because your agent may not even call it whole life insurance, since it encompasses universal life, variable life, and variable universal life. So universal life is really just a flexible version of whole life insurance, in which you can, if you have additional funds and you want to increase your premium, you can do so, or if you're in a tight spot and you need to decrease your premium, you can do so. And you do that by actually changing the death benefit over time. Variable life is the version in which your cash value is actually invested in the market into funds, and you're not just getting a stated rate from the company. That because it's invested in the market, your cash value and your death benefit are likely to fluctuate over time as the underlying funds change. Variable universal life is really just a combination of these other two forms. To sum up the last couple of videos though, term life insurance can be a very effective tool for transferring risk and limiting the liabilities of your survivors that they might face should you pass prematurely. With term insurance, it would be a very rare case that you would actually want to purchase more than you need. Whole life insurance, on the other hand, can be a very effective tax planning tool, and provided you understand the features of the policy you're considering and think very, very critically about the assumptions being made in the illustration that you're presented with, especially as it relates to the growth of the cash value. If you have any other questions though, or need anything else from me, by all means feel free to post here, give me a call or shoot me an email. My number is 720-808-6979 and my email is sean.cooper@fitfinancialconsulting.com. Thanks.